folks. We had the Dow Industrials trade up 89, Nasdaq up 25, S&P's up 10. And as we do each and every Wednesday at 20 past the second hour, we have our man, Mr. Dan Cook. Dan is the Director of Business Development, folks, at Nadex. Nadex is a North American derivatives exchange out of Chicago. It's it's a brand new exchange in the United States. You can come over to our website at tfnn.com. You'll see the Nadex banner right across the top of the site. You can hit that banner. You can get up, get the platform on your desktop in all of about 30 seconds. They'll put $25,000 in funny money inside your account. So as we're moving each and every day, of course, when we're on the air, you can basically be trading these different indices to see exactly how they work, how basically bull spreads work, how binaries work. Dan Cook, welcome back to TFNN.
Great to be back, Tom.
How you been?
I've been really good. It's been quite the week.
Oh man, let me tell you something. The bottom line is that I'm out there on your platform, and volatility is so where it's at. It's just amazing. I mean, because what happens, folks, inside Nadex is that there's different expiration times. You know, when I talk about hours, and then dailies, and then weeklies. And because of the volatility this week, Dan, it was a field day. Because what ends up happening, you know what's interesting is that I'm still wrapping my head around it, and you gave me a huge heads up last week, meaning that we could trade both sides of it, because that was really cool. But the time aspect is really cool when you get a volatile market. You know, because it's the same thing. Those spreads basically move, and that's, I mean, as a trader, we want movement. You know.
Exactly, and the volatility obviously this week has fed right into that.
Yeah, it has.
And the multiple time frames, multiple strikes published, so it continues to move with the market. So basically, we try to make them tradable.
And they are tradable. And, what I was trading, even today, I was trading gold today, and I was trading the S&P today. And, of course, the S&P moved just enough. And what happens, folks, is that you're basically doing you can do a spread, you can do an over and under. And the strike price is like one of them today that, basically you talk about just getting it to is 1366 at 415. Of course, that hit, which was a beautiful thing. But this morning, that 1366, that was only cost me $2,200 for 7,800. So it was kind of interesting, real interesting, actually.
They set up some interesting risk-reward profiles.
They do. Now, we were talking about the spreads last week. What I'd love to do is can you walk us through, first off, what the spread is, and we're going to talk crude oil, because crude oil also had some nice movement out here today because, of course, the numbers came out today.
Definitely. For those familiar with options, basically it's a vertical call spread. And I'll touch, for those of you not as familiar, on the other part in a second. Basically, there's a floor and a ceiling.
Yes.
It's a contract based on the underlying market. So in this case, we're talking about oil, where you have a range. In this case, one range was 101.50 to 104.50. I've got a floor and a ceiling. And the way it sets up, basically, if I'm long, if I'm buying the contract, my absolute risk, is from wherever I'm buying to the floor. Now, it's called a bull spread, but that's a little, I'm not sure. I'm the biggest fan of that name. Maybe we ought to have a contest to rename them. But you can also be short a bull spread. So you can have a short bias on the market.
Right.
And if you're selling, your risk is the place between where you sell and the ceiling. And we'll kind of walk through one here a little bit.
Oh, cool.
Okay. I think you've got it up here on the screen.
I do. I have it up on Target TV, yes.
We were looking at it around 8:30 Eastern this morning. Crude's trading about 101.50, and of course we had the number coming out.
Yes.
I don't know about anybody else. I don't know what the numbers are going to be in advance, and I just expect movement. I expect it to go one direction or the other, or maybe even whipsaw.
But you're in Chicago. Don't you have Mr. Beeks running around?
I'm sure there's probably a couple of them. They just don't talk to me.
Totally.
Yeah, and so basically when we're looking at this, and I'll talk about one side first.
Okay.
We've got a range. 101.50 to 104.50 was the upper range.
Right.
Now there's multiple ranges. And so if I was looking just to trade oil, if I thought oil was going to go up, well, I could put my trade on at 101.50. I got to put a stop somewhere, maybe 99.75. I've got to put up about, what, $6,800 in initial margin?
Yes.
And then, with a stop about, $1.75 away, that's $1,750 on a standard contract. If I just looked at the upper spread, basically, these are an option. So I'm giving up a little bit of time value. I'm giving up a little bit of edge to the market. So when the market was, it was a little over 101.50 when I looked at this one, and I could buy that spread at 101.93. So 43 points, 43 cents off. Now, the question might be, well, why would you give up any edge to the market? You could just buy it outright at 101.50. And the key is I don't have to put a stop on this trade.
Right.
My floor is my risk. So if I get in at 101.93,
yes,
my risk, and in this case there were 10 contracts, if I want to trade one contract,
right,
I could get in for $43.
Right.
I've got $43 risk. In this case, I did it the equivalent of an underlying oil contract.
Nice.
Bought 10 for $10 a point. And I'll put the disclaimer, this was done in the demo. I am prohibited from trading live on these. Sometimes it breaks my heart. But in this case, my total risk was $430.
And what's cool here, folks, is that when Dan's talking, if you go up and get the demo, it tells you right in the demo, which is really cool, before you actually put on the trade, what your total risk is. So when you're putting this on, it's going to tell you in the demo. You're not going to have to be guessing what's happening here. So go ahead, sorry.
That's a key aspect. Cause
it is. I love it, man, because I'm still wrapping my head around these spreads, and it's nice knowing before I'm hitting the button. Do you know what I mean?
Oh, yeah, exactly. And one thing I do encourage is using the demo first, but you'll see right on the platform, whether live or demo, what your risk is up front. And it's an absolute maximum risk. There's no slippage. It's a solid floor.
Right.
The key here is also, if I was just had a long bias on the market, because there's no stop, it doesn't matter if oil drops to 80. If it bounces back up, I still have time to be right.
Yes.
And I never risked more.
Right.
So I can basically trade stop free with lower risk in a lot of cases. In this case, rather than, if I was just looking at some analysis on that, if I had a stop at 99.75 trading the underlying, instead of risking 17.50, I'm now looking at a risk of about 430, and instead of a margin of $6,800, my margin is my risk. It's actually collateral, not margin. So I get high effective leverage without all that downside of losing more that's in my account.
That is so cool, man. Yeah.
And so, we could put this trade on one side for a risk of 430. That's also the collateral we put up. So it's lowered the barrier of entry.
Right.
It's hard to trade oil when you're only putting up 430.
Oh, no. And folks, if you've never traded oil moves, man. I mean, and it's a buck a point if you're in the future market. So it's a good scene. Well, it's a good scene if you're on the right side of it. Yeah.
Exactly. Now, we also had another spread, which was on the downside.
Yes.
Because, again, this is a directionless trade. I don't care where it goes. I'm just expecting it to move pretty solid in one direction or the other. Again, it's still at 101.50. I could sell the lower spread, which goes all the way down, actually, to 98.50. That if I'm short that's my maximum profit is 98.50. But I can get in. I can sell this 10 contracts at 101.08. And so I've put up 42 points risk times 10 contracts, $420. So my total risk on both sides, $750.
Hey, you stay right there. When we come back, we'll finish this right up. And as we're breaking, folks, you can come over to our website at TFNN. You're going to see the Nadex banner right in the front page. Hit that banner. You can get up and get a demo account right here, right now. We're going to be coming right back in with Dan and finish up this trade. We're going to be right back, folks. Right now, we're talking about a bull spread in oil, and this is a contract, folks, a demo contract, but this is a live demo that was actually done out here today. Okay, so we have the buy at 101.93, and then you were selling 10 at what, 101.08, Dan? Yeah,
that's correct. On the bottom spread, selling 10 at 101.08. So we're basically taking both sides of the market.
Okay.
I always believe in what's my worst case scenario.
Yes.
Which is always hard to define in a margined, market because it can move pretty fast. Here, my worst case scenario. I place this trade, I fall asleep, and it expires.
Right.
$750. If the market doesn't move at all, I lose $750 maximum.
Okay.
430 on the upper, 420. Also, if I don't get a move, one thing I'll point out, if I don't get any move, let's say, because I was looking for the oil inventory number
to
move the market. If it doesn't move, I can close this off early.
Right.
And I'd also recommend, a lot of times you can set limit orders out because it's possible if you get a whipsaw, sometimes after an announcement, you get the initial reaction maybe up $1.50, and then all of a sudden bias changes. Half an hour later, it's dropping through the floor. if we're setting limits out there, we could get filled on both sides of the trade.
Right.
Up and down. And so when you're looking for a whipsaw, one thing that comes to mind is non-farm payroll when you're looking at equity indexes.
Oh, yeah, big time.
But just to kind of walk through here, basically what happened, we saw oil climb today, had a pretty decent move.
Yes.
The key here was I knew what my max risk was going in.
Right.
And so one other point I'll make, well, I said earlier we'd give up a little bit of edge to the market.
Okay.
So we were buying at 101.93 with the underlying market at 101.50. We don't have to cover those 43 points. So if it starts moving from 101.50 to 101.55, our bull spread is also going to start moving. There's just some optionality built in.
Exactly.
So we're not having to cover that.
Right.
And as it gets towards the center of the range, it moves pretty much one for one with the underlying market. But if we walk through, we can see, and then probably most people listening know what happened today. We flipped up, and in this case, I was able to take multiple contracts off at a time. And that's the key. You don't have to wait for expiration. You don't have to sit there and go, geez, I hope I'm right. Have your plan going into the trade.
Yes.
And in this case, we were able to take a partial position off at 102.77.
Okay.
And then another at 102.66, and actually, missed it. It went a bit higher than that, where if I'd had, maybe a limit higher, set higher. But in this case, that side returned 822.
Right.
On the other side, we lost our 420. It expired worthless.
Yes.
We left the trade on. So if it hits our first targets, on the upside first,
sure,
great. Yeah, and then if all of a sudden it falls through the floor, even better, because then we're getting paid out on both sides.
Yes.
But the key here is, and I know I'm showing this trade work, and I almost hate to do that. I'd rather show you one that doesn't work, because it's all about knowing the risk.
Well, and many of the folks listening know that the bottom line is that the biggest, just as you said, you have defined risk. And folks, if you're looking at a chart later on, okay. In fact, I'll put a chart right up now of oil. What you're going to see is that when the numbers come out, bottom line, they come out at 10:30. Huge expansion, ASAP. But the bottom line is that this baby just took off from the price point of 1020 to be exact, 101.32, and bottom line is it takes off up to this 103.13, which is pretty amazing. Yeah. Yeah,
it was a good sized move. And if I'm trading oil, I can use these also as a short-term hedge. For example, if I was long oil,
yes,
going into the day, and it's trading at 101.50, I just put the bottom spread on, and then basically what I can do, I'm hedged. The nice thing is it's not a true hedge where I just basically take a one for one. If oil shoots up, my losses on the bottom spread, I hope it's a loss actually, run out when it hits that ceiling.
Okay.
So if it runs forever, I'm not giving the full profitability away of my underlying trade. And if I'm worried about getting whipsawed out, I could put my stop all the way down at 98.50 in the underlying, and I've made up a one for one. All I've lost or given up is basically the difference between where the underlying market was and where I'm selling.
Nice. Now, let's talk about this a little, because when we were on break, I got a couple emails, and this is what it is. Tom, could you ask him whether Nadex options can be used as a hedge for a portfolio and a stock position? So let's just talk about, let's just say that if we, let's say an S&P. I mean, it certainly can be used for a hedge for an S&P, right? I mean, for the index?
Definitely. We offer the S&P index, the Dow index, NASDAQ index, Russell index, as well as Nikkei and Kospi and DAX and FTSE.
Right. And let me, as we're talking here, folks, I'll put mine right up here so you can see. I'm going to put this up right here right now, and I guess so. What would end up happening? Let's see if we look at the indices, and I go into the S&P 500. Then more than likely, if you're going to do a hedge, and just like the market's going down this week, more than likely what you'd probably put on a weekly, Dan, right? Is that what you do? With
if I was looking at binaries, now the spreads are really done on a daily for a very short-term intraday. And
yes.
The reason for that is because you don't want a lot of optionality built in.
No, I'm with you there, right.
And so it's really like on days like today, if I'm trading oil in the underlying,
yes,
I'm looking for that very short-term hedge.
Right.
Or perhaps I'm looking for my entry. Maybe I pick a direction and I'm looking for my entry, but rather than putting up the 6,800 in margin and the 1,750 in risk,
right,
I just take one side of this, and now I'm putting up 430. If the spread runs in my favor,
yes,
all the risk on any trade is right up front. if you're wrong, get out.
Right.
So I can utilize a bull spread as an entry because I don't have to worry about a stop. How often do people get stopped out? They get into a great trade, goes down, hits their stop, bounces back in their favor, and all of a sudden it's running. They're going, well, geez, I was right all along, but just kind of had a bad entry.
No, absolutely, man.
If I started out on a bull spread, I've got that optionality, so I don't have to worry about a stop. It can drop down if I'm long and then come back up. I've got time to be right. And if it runs in my favor, well, easy enough. I close out my bull spread contract. I go in and put it in the underlying market, like let's say the S&P.
Yes.
And then I already have a stop on that market that's in profit. And so I've taken a lot of that front-end risk out.
No, and that's absolutely huge. Now, I know, there's a webinar that's coming up too, right?
Yeah, we've got a couple things coming up. We've got one, if you click on the banner on the TFNN page, that'll take you to our site.
Yes.
Register for a demo account. And then we've also got, you'll be able to register for a webinar we've got tomorrow night, which is going to, kind of go over some more of these contracts, a little bit more in depth.
Yes.
As well as if you check out YouTube, look for the Nadex channel. There's a whole what's called Binary Options Master Series, as well as Bull Spread Master Series, that'll walk through how these work.
That is awesome. Well, listen, we appreciate the education, and folks, every Wednesday we're gonna walk through this. In fact, you know what we're going to do? I got to get those videos up on TFNN too. But you can go right over to YouTube, folks, and check them out, because I can tell you, and then on Fridays, folks, the 10 o'clock to 11 o'clock, my program in the morning is dedicated to all of these trades. And Steve and I do them every morning out here anyway. So if you listen to us at 10 to 11 every morning, we're doing them then too. I mean, I love this. You know what I love? I love that you have so many different vehicles that you can actually trade. Because it makes a difference. Time-wise, it makes a difference, for sure.
Definitely a wide range of markets.
Yeah, huge, man. You have a great night, safe night. Of course, we look forward to speaking to you next Wednesday, Dan.
Sounds good. Thanks a lot, Tom.
Okay, man. Have a great one.
You too.